So welcome everyone to the virtual SaMMF seminar series. We're super happy to have today Pierre Collin-Dufresne as our speaker. He'll be presenting informed traders and dealers in the FX forward market with Peter Hoffmann and Sebastian Vogel, who are also in the audience. And we're also super happy to have our regular senior board members as well as panelists joining, and they'll play a more active role in creating lively discussion during the talk. And let me remind you of the seminar format. The talk is 1 hour, followed by a 15-minute Q&A. During the talk, as an audience member, please feel free to pose questions to the Q&A. And if it's a clarifying questions, I'll interrupt Pierre and ask him to address it. Otherwise, we'll defer to the Q&A segment these questions, and the co-authors also will be answering on the Q&A part. And as the talk is nearing, please post your questions to the Q&A or use the Zoom raise hand feature to ask your questions, and then we'll unmute you and have you ask your questions or give your comments. And in advance, apologize if we don't get to all your questions. And finally, let me remind you a couple of talks that are coming up. On Friday, November 13th, we have a workshop dedicated to job market candidates who are working in search and matching in the related areas. So we have 4 candidates giving their job market papers. So I highly encourage you to join our workshop on November 13th. And then on Monday, November 16th, Marzena Rostek, and 2 weeks later, on Monday, December 7th, Gregor Matford will be presenting as our next seminar speakers. All right, so with that, I'll pass on the floor to Pierre. Pierre, take it away.
Okay, thanks a lot. I will share my screen. You can all see my slides. Okay, let me know if you...
Yep, I can see your screen.
Okay, all right. Okay, well, thanks a lot. It's really a great honor to have this opportunity to give this talk, and I'm really impressed with all the people that are showing up. It's very grateful that you actually take some time off. So if you get too bored, and just log out and leave. You know, this is joint work with Peter Hoffmann at the ECB and Sebastian Vogel, who is a former PhD student now at the University of Rotterdam. And what we do in this paper is we look at a great data set on FX forward trading. And before I get into the meat of what we're doing, I want to apologize because when I accepted this talk, I thought we'll have plenty of time to work on this. It'll be great. We'll have lots of results. And in the last 10 months, we've not been able to actually access the data, given that it's at the ECB and we can't go to the ECB. So in the end, this is much less advanced than I would have liked. But the counterpoint of that is that I really look forward to your comments and any suggestions you'll make. We'll be actually able to use. So I'm really looking forward to your comments. So let me try to motivate what we're doing. We're essentially looking at this FX forward market. As you know, FX is a very, very large market. In many ways, it dwarfs equity markets. There's a lot of volume. And yet this market is still traded in a two-tiered market with dealer-to-dealer, inter-dealer trading and dealer-to-client trading. Many fragmented venues. And so one question, of course, is why is such a two-tiered market structure still prevailing in this market, especially given the high volume and the fairly homogeneous contracts we see in this market. And we have at least 3 and maybe more explanations, right? One is the classic demand for immediacy when you have large and infrequent traders, and you have this need for dealers to intermediate, but maybe that seems less at the heart of this market, which has a very high volume of trading. Then we have these stories that are related to adverse selection, the fact that these OTC markets, well, there's not perfect anonymity. The dealers maybe are able to use some information on the clients that they see come to trade, and maybe that alleviates adverse selection. Certainly, if you're an uninformed trader and you can signal that, then you might be interested in trading through a less anonymous market. And of course, there's the old third option, which is that maybe the dealers are able to prevent the emergence of all-to-all trading because they want to prevent some of the rents they have in these markets. And we're interested in sort of revisiting that second part and sort of thinking about how important is information in shaping trading in both the dealer-to-dealer and the dealer-to-client part of this market. And the reason we're interested in thinking about this and looking at it using the data that we have available is that when we look at the literature, we see some results that are not obviously, at least in our mind, easy to reconcile. So, first there's sort of this very, very well-known set of results that start with Evans and Lyons, that the interdealer order flow has predictive power for future FX rates, right? So everybody knows these results, and Evans and Lyons have a series of papers, right, where essentially they look at the interdealer order imbalance and they show that this has predictive power contemporaneously, but also for the next day FX rates. And then there's some results of Payne using Hasbrook style VAR regression using interdealer electronic order book data, where he also finds that the evidence is that there seems to be some a significant component of the change in prices that are attributable to essentially quotes and to orders, and so typically interpreted as evidence for private information. There's also some nice papers that have actually data on very, very short, maybe a few days of interdealer trades of a large bank, and that find that essentially the bank active in the interdealer market is adversely selected by the large banks it trades with. So this set of results seem to suggest that private information has some role to play in the interdealer market. But at the same time, there's a series of other papers that look at markups in the dealer-to-client market, and there the evidence seems to be less consistent with an information story. So in fact, the conclusion of some of these papers is that markups in the dealer-to-client market does not seem to be related to the likely information content of trades. And the biggest results are, the two results that are often pointed to in this set of papers is that we see volume discounts, so larger trades actually get charged smaller markups, and we also see that financials get substantially smaller markups than non-financial firms. And typically, the idea is that financial firms are more likely to be informed, and short-term price impact information seems to support that. So this would suggest that if we think that large trades by financials are the informed trades, the fact that they get substantially lower markups is viewed as evidence inconsistent with adverse selection being an important feature of the price discovery process in the dealer-to-client market. Now, then the type of theories or stories that are put forward are related to price discrimination based on something else. Maybe we have, we're sorting on lack of sophistication of the traders, and the dealers are exploiting these unsophisticated traders to charge higher markups, things that we also have some evidence for in other markets, such as muni bonds from the papers by Rick Green and Norman and others. And so, and an alternative hypothesis that's also put forward is this hypothesis of strategic dealing, that maybe dealers want to attract the informed order flow, and therefore they offer beneficial spreads to attract that informed order flow, to then be able to turn around and exploit that order flow, and that informed order flow in the interdealer market. At the same time, these results that seem to suggest that adverse selection is not, at least in the traditional way that we think about it, a major driver of the dealer-to-client pricing. At the same time, there's this other set of papers that seem to suggest that client order flow has actually predictive power for future FX rates. So Evans and Lyons, in a maybe less well-known paper, and they also have a 2007 working paper, they actually have access to client order imbalance from the large bank, I think it's Citibank at that point, that they're using, and they find that actually the client order imbalance has some predictive power for 1 day out to a few days FX rates. And similar results in these other papers that seems to suggest that at lower frequency, non-financial order flows seem to have some predictive power for FX rates, which doesn't seem to square with the idea that this non-financial order flow is maybe not sophisticated, and with the idea that it has no that it's uninformed. And a lot of these results that I quote there, of course, one of the limitations in the analysis is that they have very limited data, because it's very hard to have access to data from dealers and from dealers' clients. And typically they are focusing on very short, maybe a few weeks, maybe a few days of data from dealers that they got information from. And so the nice thing about the data set we have access to is that essentially we have much more comprehensive data, and we can try to take another look at essentially these types of results and maybe in a more systematic way. And the most interesting part of that is, of course, we have access at the same time at information from multiple dealers. So we can also look at what happens. Typically all these papers focus on one specific dealer and the clients of one specific dealer over a very short period of time. Instead here, we will use this data set that's now available at the ECB, and essentially is a parallel to the Dodd-Frank regulation, this European market infrastructure regulation, which essentially forces all banks to disclose their trades to various data repositories, and we can have access to the trades of these banks at through this European Systemic Risk Board at the ECB. And that essentially provides a whole bunch of trade level information, with information on the counterparties, with information on the dealers, with information on the price, with information on the time of trade, the direction of trade, and additional information, unique information on the counterparty, which allows us then to also classify these traders in various groups. So we will use this data and essentially try to answer a series of questions that are here on the slides. We essentially try to see, looking at this data, whether we find evidence for informed client trading in this D2C market, and we're going to look at price impact and look at various types of clients and see whether we see persistence in the price impact of these clients, or is it the case that we see that some types of clients have higher price impact than other types of clients, and is that persistent over time? We want to see whether there's some evidence that this price impact is priced into the markups that the dealers charge to the clients, whether that's the case across various dealers. We want to see whether this client order flow, once aggregated at the dealer level, carries information for future FX changes. Right? Since we know from Evans and Lyons that the interdealer order flow has predictive power for the future FX changes, it's natural to think that the interdealer order flow is driven by their client order flow. And so it's interesting to see whether and how the client order flow at the dealer level helps maybe the dealer forecast future FX changes. We want to characterize if there's differences across dealers and across clients. Can we say something about who are the informed traders, who are the informed dealers, who are the uninformed traders, who are the informed dealers? And something we haven't not yet done, but there's something we're interested as well, is what is the nature of this information? Do we see different types of information that are being used by various types of clients? I'll say something more to that effect. And then lastly, we're interested in this information network. So if it is the case, and it is the case, I think our results seem to push us in that direction, that there are different types of information level, and there are differently informed dealers. Then how do they trade with each other? So those are the type of questions that we want to pursue with this data set. And I'll just give you a quick summary of the results. The results we have essentially is that we find that there's a large dispersion in the client's price impact. We focus on 1 day and 1 minute and 1 day price impact, and also in the markups that they're being charged the dealers, we find that both non-financial firms and funds have large and significant one-day price impact and face much larger markups, with the non-financial firms actually having both a significantly higher markup and a significantly higher one-day price impact than funds, which doesn't square with sort of the typical idea that non-financials would be uninformed, that their trades would have no information content for future FX changes. We find that insurance and pension funds have actually negative price impact on average and pay the lowest markup, and the governments and central banks don't seem to have any significant price impact. The skill in terms of measured by the price impact seems to be persistent across subperiods, in the sense that if we sort clients into groups, and we find that groups of clients that have on average high price impact in the first sub-period tend to remain in high price impact groups in the subsequent periods. And we find that the markups are positively related to these price impact measures, suggesting that there seems to be at least some role for adverse selection in this dealer to client market. And we find that the individual dealer order flow is predictive of future FX rates, but that there's a lot of cross-sectional variation across dealers, so that we can, what we do is we define the informedness level of the dealer by the predictability of its client's order flow. So we see if a dealer has on average a high R-square when he regresses future FX rates on his client's order imbalance, and we classify this as an informed dealer. And dealers that have a not very informative client order flow, we classify them as uninformed dealers. And then we look at what are the characteristics of these dealers that are informed and how they tend to trade with their clients. And what we find is that typically informed dealers are more likely to trade with informed clients, are more likely to trade with informed dealers, which of course there's an endogeneity here, because if we define informed dealers to be informed because their client's order flow is informed, then obviously we would expect to see that. But I will try to explain how we try to control for this endogeneity, essentially by rolling through different subsets of types of traders. And then we see that even trying to account for the endogeneity, it's still the case that there seems to be more trading of informed traders seek the informed dealers, and that informed traders actually tend to trade with fewer counterparties. So the first element you might think is a little bit like in Vincent's work, and the second one is a bit puzzling in light of some of the results that have been found by Condor and Pinter, for example, where they seem to suggest that, and I'll talk a little bit more about that later, that it might go the other direction. In fact, let me talk about this now. So, in addition to all the papers that I mentioned, there's a huge literature, and I can't do justice to everybody who's worked in this field, and so I'm not going to take you through all these papers. I just want to maybe highlight a couple of papers here that I think are really relevant for the talk today. The first paper is this paper by Howe, Hoffmann, Langfield, and Timmer, and they use essentially the same data set that we use, but earlier period. And what they document, if you haven't looked at this paper, I think they have some really beautiful pictures on how the introduction of electronic trading platforms in this FX market actually decreases markups for what they classify as unsophisticated traders. So I think this is a really nice paper, and the reason I'm mentioning it is I think their results are very convincing in showing that for some types of traders, introducing transparency through introduction of electronic trading platform can lead to a huge decrease in markups, which seems to suggest that there does seem to be price discrimination on other things than just adverse selection. So even though I think our results, we think they show that there is a big role for adverse selection in these markets, I think it's certainly not the only source of driving, that drives markups. The other, I think, interesting paper is this paper that I just mentioned by Condor and Pinter. So, like us, they're also focusing on information networks, but they're focusing on the UK bond market. And what they come up with a measure of informed trading, which is based on actually the number of connections. And their intuition is that as you have more and more connections, the trader that connects to more and more dealers should be more informed. And they're their intuition is a version of, as they mentioned, as they say in their own paper, is a cross-sectional version of the Kyle idea. In Kyle's model, the informed guy will split his trades over time to hide, and their intuition is that somebody active in the OTC market should split its orders essentially in the cross-section, so have many more connections with many more dealers to try to hide. And their results are very consistent with that, in the sense that in their empirical analysis, the more connections, the more informative the trades of the agents. And interestingly, this runs sort of against the results that we find, where we seem to find that the more informed the trades, the less connections they'll have to dealers. And one intuition for our finding could be that essentially they're worried about information leakage, and so you want to have less connections if you're informed. You'd rather work with fewer dealers. So be as it may, I think.
Can I ask a question related to that, Pierre? So, do you try to separate parent orders from child orders? If clients are splitting their orders across different dealers to minimize their price impact, are you going to try to get the parent orders of clients?
That's a good question. No, we haven't looked at that. We have the trader identity, and so what we've focused on in the results I'm going to show you, we're focusing on the clients' individual trades, their price impact, and then what we do look at whether the same clients' future trades also have similar price impact. So in that sense, we have a little bit of that, looking at the same clients, but we haven't tried to identify whether we can identify the initial parent order, and so that aspect of the liquidity we don't look at. Okay, so I'm just going to, in the interest of time, move on. But I think there's something interesting here where the dynamics, if our results hold up, the dynamics in the FX market don't seem to be similar to the dynamics in this UK bond market that they identify. And of course, another set of interesting papers for our paper are these papers that focus on network centrality. And one interesting result we find is that the definition of an informed dealer is not isomorphic with connectedness. So it's not the most connected dealers that are the most informed by our measure, and so these two measures don't seem to line up, which I thought was also interesting. Okay, so now let me jump into the actual analysis. So the data we have is from this EMIR data, lots of interesting data for researchers. The only constraint is that you actually have to go to the ECB to work with it, which again in current times is difficult to do. And we also use data from Thomson Reuters, so we can compute a benchmark mid-price. And then we use this Orbis database, which gives us information on the types of traders. So we can link the unique trade identifier from the EMIR data with this Orbis data set to get information on the traders. And something we're planning to do a lot more on, because we can actually drill down and sort of have more refined groups of traders. So just to give you some sense of the summary statistics, you can see here the classifier. So here again, we haven't done that much work yet on getting more refined groups. So these are the groups that we get based on the Orbis data, and you can see if you just focus on that, you can see there's a lot of dispersion in trade sizes and number of counterparties. And if you just focus on the typical traders that we think would typically inform, if you focus on funds, you can see that typically the funds, they trade, if let's say you compare funds to insurance and pension plans, you can see that funds typically trade smaller sizes, and that they typically trade have fewer counterparties, even though they trade more often, more frequently, right? So this is something to bear in mind, right? That we see this dispersion, and just based on that already, there seems to be this pattern that the ones who would classify as informed tend to essentially trade more often, smaller notionals, and have fewer counterparties. Now we're going to compute a benchmark mid-price. So based on the Thomson Reuters.
Yeah, can I interrupt you? Just a quick question.
Yes,
a given bank can have different trading desks, right? And so here, do you aggregate everything at the level of a bank, or you consider them as different traders?
No, I think we use the information we have from. So we use the information we have from yeah, from this EMIR data. So I think a unique classifier will be at the bank level. We're not going to know, which desk is trading within the bank, unfortunately. Yeah. Yeah, that's of course that's a concern. Yeah.
So in terms of the contracts that are traded, these are what kind of contracts? Is forward, I understand, but there is some heterogeneity. Are they? Can you tell us a little?
So here we're focusing only on Euro USD currency forwards, and we're looking at, you can see there's some disparity across the cost of maturity, right? So, and you can see also some disparity in who trades what maturity, but we're not, the data, of course, in the data, you can have access to anything. You can have access to options, you can have access to other currency pairs. We focus only on Euro USD currency pair and plain vanilla forwards. We're not looking at spots. We're focusing only on this. Data is on essentially the derivatives trade by banks in the euro area.
So Pierre, can you say something about the trading mechanism? Are they on venue? For this pair, the EBS is probably the most liquid one, right? I mean, are they trading on EBS or OTC?
Yeah. So indeed, there is also in this other paper that I mentioned where there's also some information on which trading venues that these guys are trading on. Now, for interdealer, we're not focusing here on the interdealer trades. On interdealer trades, of course, they would be mostly focusing on EBS, like you say. We're focusing mostly here on the D2C market. And there's a range of different venues. We're not yet exploiting the different ranges of venues, even though there is some evidence out there that the venue, including this paper I mentioned, that the venue you trade on is going to have a big impact on the markups that you pay. But all these different venues, right? It's still very much in a sort of D2C flavor of trading, where the clients essentially, whether they're going to trade on some electronic platform or whether they're going to call you over the phone, are going to ask some requests for quote and get some quotes from the dealers. Right? So, but there's a huge dispersion in effects, right? So you also have some retail aggregators. You have lots of things, and we're not exploiting that. So that's why also there's a lot of cross-sectional variation, as you'll see in the price impacts.
I have a simple technical question. Like a lot of trades in foreign exchange are going to be essentially time swaps, where you're swapping one date for another, or spot for a forward. How does the data set handle that, especially the spot for forwards?
Okay, I'm not sure is the answer. We'll have to look into that. So what exactly you have in mind? So
a person who bought a 30-day forward 25 days ago or 30 days ago might want to roll it into another 30-day forward. So they just sell their current position and then buy a position further out. So it's really a spread trade that's an interest rate play.
Sure.
And I was just wondering how those get reported and how you identify them, and especially if it's a spot forward combination, if the spots don't have to be reported because they're not derivatives, but the forward leg has to be reported, you're missing out on the substance of the trade.
For sure. I mean, that's a very good point. We haven't done that yet. So right now, if I will look into it. I don't know. Yeah, for sure. If something like this is happening, then this might also contribute to seeing lots of dispersion in what we see. That you might have lots of these trades with much less risk in them. It's just a roll. And
so my hypothesis will be that the insurance and pension funds might do a lot of this trading because their business revolves more around interest rates.
Yeah, that seems
that would explain why they're bigger.
It would explain why they're bigger, and also why as you'll see, their markups are tiny. Yeah, so that's certainly a good explanation. Something we'll look into it.
Pierre, it's Pierre. So I have just could you comment a bit on the MT category, which who are in this category? Are some trader type more likely to be in that than others?
Yeah, that's a good question. That's a great question. I mean, something that's on our list of things to do. So we don't know. I can't tell you who they are. They're just not classified by this Orbis data set. But we have a unique trade identifier. So we're planning to refine that, right? So we're planning to do that. But unfortunately, it's been 10 months. We can't access the ECB, so we don't know. But yeah, no, this is so these are all unclassified by this Orbis data set, but we have information on them we can try to link to and refine. Also, I think for all the other categories, we have funds here, but funds is also, a placeholder for many different types of funds, hedge funds, mutual funds, there's lots of different kinds of funds. And we can do more so hopefully in the next version, we'll have much more refined classifications. Also, for banks, right? We would like to essentially have something where we classify them. Right now we differentiate between G16 and other banks, but we'd like to have a much more refined sets of banks, right? There's some evidence that smaller banks, have very different trading patterns in the interbank market than large banks. And right now we only distinguish G16 from the others. So yeah, this is a limitation of this story and of our analysis so far. I can only apologize. Okay, so what we do, so we compute a benchmark mid price based on this Thomson Reuters database, and then we compute markups based on the transaction price difference to the benchmark price for buys and benchmark price for classic approach, and then we compute the price impact as the change in this benchmark mid price over the next minute when we look at 1 minute price impact, and over the next day when we look at 1 day price impact. And let me just first show you some aggregate statistics there. Again, they're pretty gross, but here you can see the average price impact across these different classes of trader types, and you can see the markups on the right hand side. We're not allowed to report for some legal reason. We're not allowed to report that number, but we can report the other ones. And so what you can see is quite a bit of variation in that markups. And you can see that the non-financials pay much higher markups than, say, funds, and themselves pay much higher markups than say insurance companies. And this is sort of one part of that price discrimination argument that I mentioned before. And the second part is that if you focus on very short-term price impact, then you don't seem to see a related variation in their price impact. So you can see that if you just focus on 1 minute, then non-financials don't seem to have a very different price impact than, say, hedge funds or insurance and pension plans. So it doesn't seem like non-financials are more informed, and yet they pay much higher, markups, which is typically consistent with some of the results I mentioned. And then the conclusion of this is typically that this is just a price discrimination based on lack of sophistication on non-financial investors.
Yeah, can I ask a quick question? Sorry, this is Ben Lester. Just because I can't look across your two slides at the same time. Was there a relationship between the markups and the number of counterparties that these guys had in a month?
So you can see that, yes, in some level. You can see that the yes and no. So you can see that the number of counterparties, right, are tend to be much lower for funds and non-financials than, say, for insurance.
Mm-hmm.
And
but they have.
Well,
yeah, I guess I'm thinking about some of these stories related to either like search frictions, where you think that somebody who has a wider set of counterparties might get a better price, but then on the other hand, if you have very few counterparties, then I start to think about the importance of these relationships, these ongoing relationships.
Yeah, so those are good points. What I want to emphasize, I'm not sure about is that this story seems to be consistent with this price discrimination story. But if you focus on 1 day impact, then you start to see a lot more variation, right, in the information content of their trades, if you saw it. And you can see that the 1 day impact of non-financial is actually substantially higher than the 1 day impact of funds. Okay, and if you look at how these numbers line up with the markups, they actually seem to line up a lot better. So
yeah, fair enough. The literature that I cited sort of focuses on very short-term price impact typically, and the argument is that that dealers in this market shouldn't care about the longer horizon impact because they tend to be flat and have very high frequency mean reverting
inventories. But these results seem to suggest that maybe there is a link between the markup that these guys get traded on average and their one-day impact. And the one-day impact seems to be consistent with this evidence from some of these papers that focus on client order imbalance and find that client order imbalance have predictive power for at 1 day or 1 week horizon for FX rates. And so at least.
Pierre, there's a clarifying question on how do you measure price impact? How do you estimate that? And this is from Adam Bayboot. And for each trade, are you just looking at the defined price change over a subsequent 1 minute or day? And how do you think about the other trades between the trade of interest and the end of period for the price change, i.e. 1 minute, 1 day?
Yeah. So what we do is I think pretty standard. But we look at we have the time of trade in the EMIR database. We compute the mid from the Thomson Reuters data, where we look at the best inside spread, and we compute a mid based on that data. And then we look at the change in that mid price subsequent to the buy or the sell, and we look at that change over 1 minute when we do a 1 minute horizon, or we look at the change from that day to the next day's close if we do it 1 day price impact. So that's how we do it.
And the Thomson Reuters mid price, is that only client to dealer trades?
Yeah. So the mid price, we focus on this Thomson Reuters database, the inside spread that we get from that. Exactly. Yeah, we don't use the interdealer electronic limit order book for that. It's something we could look at as well. Actually, it's an interesting thing, but we haven't done that. Yeah. Do
you observe the distribution of markups across dealers?
Yes, we can. We have information on that.
So would there be dealers, for instance, this is related to Ben's question. So other dealers that with whom, if you trade, you have lower markups and others that have higher markups. And does this depend on the number of counterparties of the dealer themselves? So if a dealer has more counterparties, perhaps you'll trade at a lower markup, and if they have fewer counterparties, you trade at a higher markup.
So it's a great question. I don't think I'll be able to answer your question exactly like that, but I think the results I'm going to show you are going to give you some flavor of answer. This is exactly what we want to look at, which is I'm going to try to refine this analysis and tell you which clients seem to have persistent price impact, and do they get charged higher markups by the dealers, and which dealers do they go to? Which is not exactly your question. I think your question is, do I see for one client all that's what you're saying, right? You want to know for one client all the markups that they are facing?
No, for a dealer. I'm curious whether the client dealer markup depends on the number of counterparties of the dealer. So if a dealer has many counterparties, then to each client, he's going to charge a lower markup. So kind of the liquidity within the dealer can smooth out all these trades, so then he's going to charge a lower markup. If the dealer has fewer counterparties, then he's going to charge a higher markup, because it's perhaps what Ben said, is search friction, so it's less liquid. The dealer himself has can cross trades less liquidly, so to say.
It's a good question. I don't know that I can answer your question off the top of my head like this.
Well, can I jump in? I think the friction here is that, like Ben and Anna are talking about, take the network and the number of counterparties as given, and then solve for prices. Whereas Pierre, when he talks about his results, he talks about, here are the prices that are offered, and we will try to understand the choice of dealers, right? It's kind of the other direction. I think that's.
Yeah, exactly. So I haven't done the picture that you're asking. I don't have the statistics to give you the answer to your question. I will do exactly what Vincent said, which is I'm going to tell you what I'm going to try to tell you what predicts a particular trader's choice of a dealer, given the characteristics of that trader's order flow. Not exactly what you're asking, but
I have a question about this negative price impact that you see for the insurance and pension funds. Do you have some stories about that? I've been trying to understand it. I mean, one thing that I could think of is that they're buying when more generally there's a fire sale in the market, but they're not buying enough against that fire sale. That, you know, see what I'm saying? So that could be one reason why this is happening, but more broadly, what have you had some thoughts about what's going on there?
I mean, I don't have a smoking gun explanation, but it could be that some of these traders, they're more in the market to hedge, and so if they're hedging, then on average maybe they might be losing some money systematically. That could be one story. Another story could be that that I don't know, that would be that they may be so less informed in the sense that they're being taken advantage of by the dealers who quote to them prices in a way that maybe their markups look small, but they're systematically on the losing end, so that they're part of this negative price impact could be the actual cost that they're being charged by the dealers. So if you buy our stories that some dealers are actually much better at predicting the direction that the foreign exchange rate is going, because, for example, their client order flow is informed, and they have some clients that are less sophisticated or have less information, then that could be one story.
Pierre, do you have time for one more?
Sure.
There's quite a bit of research on the fact that dealers give less attractive quotes on FX forwards that span quarter ends because of balance sheet. So I don't think it affects your results directionally, but in terms of precision, is it possible to control for that?
I think it's a great question. Sorry, go ahead.
And just a follow-up, do you think that private information that you're talking about is about the macro monetary fundamentals of the FX rate, or about the amount that I want to trade? Because it has different implications for how to interpret your data.
Yeah, it's great. It's a great question. So, I mean, both. I mean, the first question I think is also it's sort of a little bit like Pete's question before. We need to do more to separate. There are different reasons why people trade, and of course, they're going to affect for sure the markups and a little bit like in the credit default swap market. If there are rolls, we obviously see that the spreads are much smaller. So here, all these types of trades you mentioned will affect our results in the sense that we'll observe much lower markups, and they'll make our results less precise. So it's something we need to look into. On the second part, I think this is a really interesting question and something we want to do follow-up work in the future, which is what is the nature of the information that these different traders are trading on. So if you look at this picture, if you buy the idea that funds have some predictive power and so do non-financials, what is the nature of the information? And I think there's at least two stories out there. One would be that these non-financials, they could be multinational corporation active in international goods market, so they might have access to this person information, or maybe they don't even know they have access to this, but they do trades that are motivated by international demand for their goods, and that seems to have an impact on the future imbalances and therefore future exchange rate. That story would say that it's much more thank you. That story would say that it's much more long-lived information. And then of course an alternative story is that people trade based on, if you think about banks, they trade based on rebalancing of their clients, and that's maybe more something about order, their clients' order or future order flow, and more something about risk premium. And so that suggests something that we can do, of course, in the future. We haven't done, unfortunately, but it's just try to separate and decompose the FX rate changes into these different components, and see if we find that the predictive power of these different clients' order flow, right, is more helpful to predict one or the other component of the exchange rate. There's a little bit of that had been done in this old paper by Evans and Lyons, where they had data from Citibank for a short period of time, and they concluded that the predictive power was more about the portfolio rebalancing aspect of things, so more about the risk premium component and future in future interest rate changes, for example. This is something that we have on the list of things to do. Because one thing we do know is that the frequency of the order imbalance of the financials and of the non-financials, they're operating at different frequency. So the fact that they both have predictive power, I think, is interesting for something that we want to pursue. Okay, so then we look at the persistence of the price impact. So what we do here, you have sort of 30 circles. What we did is we took out all our traders, and because price impact is very noisy, if we just sort on price impact, we might be sorting on just the noise. So we tried to do groups of traders, and we did something really simple. We essentially sorted traders on the number of trades that they do. So from the traders that trade least to the traders that trade most, and then we form 30 groups by essentially putting the traders into 30 groups, so that each group has roughly the same number of total trades. So 1/3 of all the trades in every group. And the idea is that hopefully there's some correlation between your trading frequency and your ability, in which case we will, by looking at the average price impact for each group, we have something that correlates with your price impact. And so then what we do is we look at the price impact in the first half of the sample, that's on the x-axis, and then we look at the same group of trader, what is its price impact in the second half of the sample, and we try to see whether there's persistence in the ability essentially of these 30 groups. And what you see is here is that there seems to be some ability in the sense that your price impact in the first half of the sample predicts out of sample your price impact in the second half of the sample, and the evidence is stronger at the 1 day level, and you can see the number, the significant coefficients in R squared. And then we do look at.
Can you do a double sort with trader types as well? I mean, you'd think the trader types itself would determine trading need and frequency, etc.
Yes. So this is something that's on our list to do. Yeah, we want to do that. So we will do that. I haven't done it yet. I can't show you the pictures here, but yeah, a lot of things we need to do. But indeed, one thing we have done is this, where we essentially refine the trader types into traders that seem to have, that seem to have shorter horizons and traders that seem to have longer horizon, by looking at what we call HFT, a bit pompously, because we actually classify HFT as traders that do more than 10 trades a day. So it's not really what we think of at HFT in the equity market, but in the forward market, more than 10 trades a day seems to be a large number of trades. So we look at what we call as the traders that trade frequently, the HFT and the non-HFT. And then what you can see, which is interesting, is that the so-called HFT, the ones that trade frequently, they have much more persistent 1 minute price impact, but the non-HFT, they have no persistence in the 1 minute price impact. Instead, if we look at the non-HFT, they have very persistent 1 day price impact, whereas the HFT have, somewhat persistent, but much less persistent 1 day price impact. So you can see that the type of clients, right, and seem to matter for your horizon, for the horizon of the information that you trade on. The size of the dots is correlated with the average notional traded, and so what you can see, unfortunately, this is sort of automatic, so you can't compare across graphs. But what you can see when you focus on any given graph is that there doesn't seem to be a clear pattern. If anything, it's the larger trades are not out there on the right. So no matter which picture you look at, you don't see evidence that the high skill or the high price impact guys are the guys who trade large quantities. So that's consistent with this volume discount type of results that we have in these OTC market. But you can see here that it's doesn't fully correlate with the interpretation of the volume discount, which typically says that we would think the larger trades are more informed. Here doesn't seem to be the case. If anything, it seems to be the other way around. That the more informed trades seem to be the one that typically are smaller, which is more consistent with sort of order splitting, if you want. So I'm going to drop this. We can confirm these results that I show you visually with statistical significance. The next thing we do is we try to characterize those informed traders. So a little bit like what Pierre Olivier was asking, but what we're missing relative to what you're asking is, and I would like to have is to tell you where the non-financial, the financials are, etc. But we characterize them using their statistics of their trades. And what you can see, if you look at the high price impact versus the low price impact guys for the non-HFT or the frequent traders, in both cases, you can see that typically the high informed guy, they trade smaller notionals than the less informed guys, right? So the notional traded by the informed guys is smaller. And you can see that the highly informed guys have a smaller number of counterparties relative to the less informed guys, whether they be high or low price impact guys, right? So you can see that that it seems based on this characteristic that the more informed guy, the guys that have persistent price impact, they trade smaller notionals and they trade with fewer counterparties, which again might be consistent with information leakage concerns, but it's not the same story as the one that was put forward by Condor and Pint in the UK market, where they actually find the opposite, that typically the guys that have more connections tend to be the more informed guys. I'm going to drop this table. It's the same thing. The statistics are confirmed. They're just the table that I showed you. The next thing is we ask, well, are the dealers informed? So we know from Evans and Lyons that interdealer order flow predict future exchange rate movements. Obviously, since interdealer order flow is probably motivated by the client order flow, is it the case that at an individual dealer level, his client order imbalance or volume imbalance, we look at both, can predict the next day or the next week forward change in the exchange rate? And so we do a regression of the one-day forward rate for this table on the previous 5 days order imbalance. And what we find is that essentially there is in aggregate quite a bit of predictability. Client order imbalance predicts future exchange rate, but there's a lot of variation across dealers. The average R square around 2%, which is at the daily level, daily R square. So it looks small, but if you transform that into a sort of Sharpe ratio on a trading strategy, you can use a nice formula from John Cochran's paper. You can see that this out of sample 2% daily Sharpe ratio translates in quite a bit of potential trading gains. But we see a lot of cross-sectional dispersion. So what we will do is we will essentially look at, we will rank the dealers according to their R square and classify higher R square dealers as informed dealers, low R square as less informed dealers. And we try to look at what distinguishes these differently informed dealers. And so here we're, to avoid outliers, because some dealers in this sample trade very little, so we try to throw out the dealers that don't have regular activity. And so we focus on dealers that have more than 0.5% of the volume. And I split it up in between 0.5 and 2.5%, and then more than 2.5 of the volume done by the dealers. So if you look at dealers that do more than 2.5% of the volume, then you have essentially focusing on G16 dealers. If you look at dealers that do more than 0.5% of the volume, then you see that you have many dealers that are not G16 dealers among the informed dealers. So if you focus on dealers that have more than 0.5% of the volume, then you see that only 16.7% of them are G16 dealers, meaning the dealers classified as informed in the sense that their dealer order or that their client order flow is highly predictive of future exchange rate changes do not seem to line up with the ones we consider as the largest dealers. And when you look at what distinguishes these informed dealers from the uninformed dealers, you can see that typically the notional traded is smaller for the informed than the uninformed. Notional traded is smaller for the informed than uninformed. And you can see that typically they have less D to client counterparties, and they have less D to D counterparties, right, on both sides. So what you see from this table is that the dealers whose client order flow is very informative of future exchange rate changes typically have fewer counterparties both in the interdealer market and in the client market, and they tend to trade smaller notionals. So this classification as informed and non-informed dealer does not line up with our sort of centrality or connectedness measures that we typically put forward in this dealer network literature. And we can then try to relate.
Is there any relationship between the dealer's informedness measure that you have constructed and the market share of these dealers, maybe market share of client trades, instead of just classifying whether they're more, G16 or not.
Mm-hmm.
It's a little different way to think about their, I guess, centrality.
Yeah.
I'm trying to understand like how much of this is just driven by the fact that, I know you're trying to say like it's not driven by just the sheer size and volume of the client orders these dealers are getting. There's something else going on, and I'm not sure I quite see that yet.
No, okay, it's a good point. I mean, you can see that clearly the G16 dealers, they're, a large fraction of the G16 dealers will be in that sample. They'll be both uninformed and informed, but it doesn't seem to line up just with size in that sense. But I get your point. We can do more work in trying to, I guess. So what you would like to see is what is the share of the total volume of trading that these guys do?
Yeah, both on the client side as well as maybe on the interdealer market.
Okay. Yeah, my impression is that it doesn't line up purely with size, but maybe a fraction of trading. It's a good question. I will answer you when we can run that statistic. It's a good question. We then look at, can we explain the markup? So the markup that's charged by a dealer to a particular client, can we explain this? And do we see differences between markups charged by dealers that are classified as informed and dealers that are classified as uninformed? Do we find differences? And essentially what we find is that the dealers that are classified as informed, so they're, a dummy that's 1 if they're high R squares, that the markup of these dealers are much better at forecasting the future realized price impact of their clients. And so we find that that in that sense, these informed dealers are better at setting markups. So you can see that in these statistics here, where the interaction of the dealer markup with informedness dummy is significant. But if you use connectedness in the sense of number of connections, then that doesn't work as well. So it's not, or it doesn't work at all. So it's not the same type of signal that you get from this informedness classification that we have. Sorry. And we also find that so these tables here are with client dealer fixed effects. So they'll essentially say that markups of informed dealers forecast future realized price impact. Yes, thank you. Better than markups of uninformed dealers. So this is with client dealer fixed effects. When we drop the client dealer's fixed effect and we throw in our dummy of an informed trader, in the sense that this is a trader with persistent price impact, then that's captured by the markup. So in other words, the markups that are charged by dealers seem to be higher for clients that are classified in the high price impact group, which is suggestive that that there's price discrimination on the basis of essentially the history of trading of these clients, right? So a client that was classified in a high price impact group will get charged a higher price impact, and you can see that it becomes statistically significant when you drop the client fixed effect in those regressions. The last thing we do is we look at and what we call the relationship between this information measure and the network structure, and we try to say, can we predict with trade and client characteristics? Can we predict whether a client trade will occur with a high R square dealer? So if we define, we have all our history of trades. We have our measure of an informed dealer, somebody whose client order flow is highly informative of future effects changes. And we say, okay, we put a 1 when a trade happens between a client and one of these informed dealers. Can we predict that indicator function? And what we find is that essentially the informed clients trade informed traders tend to trade more with informed dealers. Okay. Now here, of course, there's an endogeneity problem because we define we define an informed dealer as someone whose client order imbalance is informative of future exchange rate trades. So we try to circumvent that endogeneity problem by essentially recomputing our measure of dealer informedness by dropping one client group. So for example, we drop the financials, and then we without financials we say, okay, is the R square of that dealer based on his client order flow, excluding financial, is that predictive of future exchange rate changes? And so we recompute the R square and we reclassify the dealers, and then we look at only the trades from the subgroup that we dropped, and we say, are those financials more likely? Are the financials we classify as informed traders more likely to choose an informed dealer, where we classify the informed dealer excluding the trades by the financials? I hope that's clear. So we're not using the same groups to define the informedness level of the dealer, right? And to test which dealer the client group chooses. And we find similar results. In other words, the left out group of traders will select when we rank them according to their price impact, the high price impact guys will tend to choose the more informed dealers. So in that sense, we hope to mitigate that endogeneity bias in identifying that relationship between, I guess the point we're trying to make here is that we think that it seems like in equilibrium you have a dispersion of skill as measured by the cross-sectional dispersion and price impact of these traders. Some traders have persistent price impact, and we see that these traders tend to go and trade with the more informed dealers who typically have a limited set of connections. That's essentially what we think these results show. We have a little model in the paper, but I'm gonna drop it because we are changing the model. So next version of the paper will be completely different. So since I'm almost out of time, I want to conclude. So again, this is very preliminary work. We wish we had done a bit more and been able to better answer some of your questions, which is something we'll put on our list, and hopefully next time we'll have better answers to your questions. But I think what we have found is that there's a lot of dispersion in the price impact and the markups that are charged to different types of clients. Non-financial and funds, for example, get charged much higher markups, but these markups line up also with their one-day price impact and not so much with their one-minute price impact. The price impact seems to be persistent across some groups of traders. So some traders seem to have persistently high price impact. Some groups seem to have persistently negative price impact. The higher price impact traders in our sample tend to get charged higher markups. The dealer client order flow predicts future change in exchange rates in this sample, with some cross-sectional dispersion that allows us to classify some dealers as better informed dealers. And we find that the markups set by these more informed dealers seems to be more correlated with current market conditions. So they forecast the realized price impact of their clients better. These informed dealers seem to be better at setting markups. The informed traders we find seem to be more likely to trade with informed dealers, and they have fewer counterparties, and they tend to trade smaller sizes. There's a little bit of an endogeneity there because we define informed dealer as dealers whose client order flow is predictive of future exchange rate moves. We try to account for that. Whether this convinced you, I'm not sure. In a nutshell, I think these results, if they hold up, they give maybe a little bit of a different perspective on this results on volume discounts and price discrimination that we discussed before, in a sense that maybe they leave more room for an adverse selection story. And I think maybe they require to think more about the nature of the information that these different types of clients have access to. The measure of dealer informedness that we have doesn't seem to also line up completely with this measure of centrality, although, as Sebastian, you mentioned, maybe we need to do more work here, thinking about different measures of centrality, which I think that's something we need to push forward. So there's a lot, I think, this is very preliminary. There's lots of questions. I think one question Daryl raised, and I think something that's on our list is, what is the nature of the order flow of these funds and non-financials? be great to classify them, refine the classification, because funds is a big group, and we can probably refine these groups of traders. Similarly for non-financials, I mean, I can have a story where large, multinational corporations, because of their activity across the globe, probably can have, I would think, in a world where there's a lot of dispersed information, they could have probably substantial information in their trades on currency movements, but probably not the same doesn't hold probably for small or medium-sized enterprises. So I think something we'd definitely like to know is to distinguish and refine the classification of these groups and see whether we find evidence to that effect. And then, as we discussed in the response to Daryl's question, right, it could be something about portfolio balance, or banks have information about how their clients rebalance their portfolios that may have some information that they can trade on about future exchange rate changes. This might be a different nature of the information than large multinational corporations have access to, which may be more about more macro fundamentals. So that's something really nice to push forward. I think the other question that we would like to look into is, so we have this evidence that client order imbalance at the dealer level forecast future exchange rates. We know that the interdealer order imbalance from Evans and Lyons type of analysis forecast future exchange rates. What we haven't done and haven't had a chance to do yet is to look at how together these things forecast exchange rates. Is it the same information? Is it different information? This will be also interesting in understanding the price discovery mechanism, how D2C trades and interdealer trades help in price formation in this FX market. So we want to essentially throw the aggregated client order imbalances and the dealer order imbalances in some predictive regressions to see how they predict future exchange rates. And then there's this question about dealer horizon. A lot of the literature that I mentioned in my introductory slides, they focus on very, very short horizons for price impact, below 30 seconds, 1 minute, because they argue that the dealer inventory is very short-lived. And I think with our data, we can actually compute dealer inventory and look at, and one question we have is it, maybe it's true that for most dealers, their inventory is highly mean reverting, but is it the case for the aggregate dealer inventory that they mean revert at a very high frequency? Certainly, intuitively, if the client's order flow is zero, okay, I'll close with that last idea. If the client's order flow is predictive of 1 day or 5 day exchange rate movements and is persistent, then it's hard. Then the client's trade must be highly correlated. And at the end of the day, if all the dealers want to be flat, somebody has to take the overnight risk on the other side. And so you think that even though dealers might be flat, they still should care about that longer horizon price impact. And so that might be why it's priced in. So these are the list of things we're looking to do. Thank you. Sorry.
Okay, thanks a lot, Pierre, for your interesting talk. So I'll open up to Q&A from audience members. If anyone would like to ask a question, please use Zoom raise hand feature. Otherwise, panelists, feel free to also jump in and ask a question. Go ahead, Larry.
Pierre?
Hey, Larry.
Pierre?
Yeah.
Very Lesson here. So I wasn't sure when you were talking about the market structure, at least a number of these D2C transactions must be via a request for quote, right?
Yes.
Is there name give up in the request for quote?
So my understanding is that in the FX market, you always get the name at least after the trade, even in the interdealer market. I think in the electronic limit order book, even there, you don't get it right away, but you will know afterwards who you traded with. I think that is my understanding.
Okay, because it occurred to me that if there were name give up at the time of requesting a quote, as it is, say, in the corporate bond market, then it actually could be the case that informed dealers are choosing informed customers so as to become informed, yeah, and profit then subsequently in the interdealer market.
No, absolutely. So this is you're absolutely right. This is one hypothesis that what people call the strategic dealing hypothesis. So they argue that so this is one hypothesis people have put forward for why some trades by financials who one would want to classify as informed get lower markups, and the idea would be that they're essentially exploiting the information from these trades to then benefit from these trades in the interdealer market. So that's definitely one mechanism that's been put forward in the literature. One issue I have with that story is why would the dealers are presumably very rational people and very smart, so they would know that they would probably charge very high bid-ask spreads to an incoming dealer who wants to do a large trade and who's exploiting that, right? So it's like, it's not. I'm not saying I don't know that it is not the mechanism, but it seems an implausible mechanism to me that you would willingly charge a very low spread to a highly informed guy and then turn around and then manage to exploit it by trading with a dealer who is as smart as you and as informed as you. So, okay, so maybe be more precise. One thing that I would like to do, which we haven't done, is to actually look at the relationship between the client's trades and what happens in the interdealer market. So in this data set, we also have the interdealer trades. And one hypothesis is that it's a little bit like in this paper that I co-wrote with Benjamin Jung and Anders Charler on the CDX market, where we see that most of the trades in the interdealer market, even though in the interdealer market you have a quoted bid-ask spread and the ability to trade whether on the electronic limit order book, we see that most of the trades happen actually inside the spread, because these interdealers, they exploit various trading protocols that allow them essentially to trade at mid. And but when the trades of the clients become very let's call them toxic, then that trading protocol shuts down, and then the dealers have to trade at the central limit order book bid-ask spread, would happen to be the widest. So to me, that seems like a more rational approach, and rational. I don't know, but so what would be interesting to see, and something we'd like to do, is to essentially look at that, which is, what is the counterparts, right? How do the dealers trade subsequently to having traded with clients in the interdealer market? Do we see that the markups that the dealers get in interdealer trading, do they have the same? Do they follow the same pattern? On average, they tend to get much better execution.
Okay. Next we have a.
You look at the area. I'm not sure I make sense to you. So tell me what you think.
No, it seems to me that the interdealer market is primarily existing for people to unload inventory, right? And so you wouldn't necessarily have a breakdown at some people had information and trading with people who had inventory concerns. And correspondingly, there could be times at which the market does break down, as sort of you kind of see market.
No, that's right.
Okay, so next, Michael Schneider, if you want to unmute yourself and ask your question.
Yes, can you hear me?
Yep.
Great. So very nice paper, very nice project. I was just, as you were mentioning dealer inventory, can you say a little more of what you looked at there and what you're observing there? I mean, you were saying the mean reversion is quite quick. So how do you measure that?
No, I was saying I would like to do more on this. So all I was referring to is existing papers, the papers that I listed on the maybe I can go back and share. So there are some papers here that have actually looked at, some of these papers have actually looked at the mean reversion speed. So they have detailed data on one particular interdealer bank active in interdealer market, and then they look at their inventory, and then they just basically compute AR1s, and they try to estimate the frequency of the autocorrel of the, they try to estimate the half-life of these of the dealer inventory for the data they have. And I mean, what's interesting is actually that as I remember one of these papers actually, that they actually find that if they just do a naive estimation, that actually they find that these dealers don't close their positions overnight. They actually have a very significant overnight exposure, but then they have a different approach to estimate the autocorrelation coefficient because they don't think this is a plausible finding, and they sort of assume that they have some missing data, and then they essentially constrain the inventory to go to zero, and then they find half-lives that are, as I recall, of the order of 15 to 30 seconds. So I think there's at least a couple of papers that have looked at this data. We haven't done anything yet with our data, but I think we have the possibility with this data to actually try to construct the dealer inventory based on the past trading and sort of look at whether we can do some statistics on that. And I think something that would be useful to do.
Yeah, I think that would be very interesting. Thank you.
I mean, I'd be curious if you have any opinions out there, because I mean, I just find economically that it seems difficult to believe that if the number of trades is not huge, the volume of trading daily is not huge, number of trades, and if the client order flow is informative of future exchange rate changes, it must be quite correlated across clients. So I don't see how all the dealers could be flat overnight and have no overnight risk. But it's something that I would love to.
Isn't it going to be impossible to measure? Because in addition to their forward trades, you've also got their spot trades, and then they may be trading short-term bonds or money market instruments denominated in a particular currency. So their foreign currency exposure is impossible to measure unless you can measure everything they own.
Yeah, you're right. Right, and they could hedge with other products. So how to establish the overnight exposures? Very difficult. I agree.
All right. Looks like we have one more question. Oh, Chao Jung. Go ahead, Chao Jung.
Can you hear me?
Yep.
Okay. Hi, Pierre. So it's just a quick clarifying question. In the foreign exchange market that you're looking at here, and also the the CDS index market that you looked at in the other paper, what is the trade disclosure rules, like public dissemination of transaction prices, quantities, etc.?
Okay, that's complicated. So okay, so in this, you mean like for post-trade disclosure?
Post-trade, like trace for the U.S. corporate bond.
Okay.
Yeah.
I mean, so in the CDX, I mean, I will not be able to give you the exact detail, but in the CDX market right now with the data repositories, right? So all the trades that are forced to be traded on CEFs, right? Which is the bulk of the index, the liquid index trading. These trades will be reported right to the trade repository, and that's publicly available to anybody. So you will know the the trade, the price, the size, etc. Now there's a subset of trades that are classified as as large trades. They don't have to be disclosed immediately. They have some time span during which they can remain non-declared, and it'll be disclosed with some time lag, and the size beyond which that's allowed, that depends on the liquidity and CDX HY will have different different rules than CDX IG for that disclosure rule. In the so that's the answer for the CDX. So you can have access to that information very rapidly, and it's publicly available. In the FX markets, I don't know the timing yet I have to look into this. I don't know that information as well. But similarly here, well, okay, it's not the same. Yeah, it's not the same. Sorry, because yeah, this data is not publicly available to you. You have to go to the ECB and get the special clearance to be able to access that data. So yeah, it's not the same. Do you have something in mind about this?
Yeah, yeah. Thank you very much for clarifying. So actually, I'm been working on a new project with Jinyuan and Gabor Pinker that find evidence of the opposite evidence for adverse selection. We can send you that paper, but in a different market. And what's crucial there is no post-trade transparency. So that is important for us to find that more informed traders get actually better pricing, not worse pricing. So lower markup, in your language. We can forward that paper to you shortly.
What market are you looking at?
So the date. So it's a theory paper. Then we looked at the UK government bond market, the treasury market.
Okay. Interesting.
Mm-hmm.
All right, so if there are no more questions, we'll formally end the talk here and stop recording, but we'll keep the room open so that those interested in joining us at Wonder or UTribe, you can copy the link from chat. And we'll keep the room open if anyone wants to, continue talking, but we're just gonna end the recording here. All right, thanks a lot, Pierre, it was very interesting.
Thank you, thanks a lot for inviting me.
Thank
Thanks for all the comments. Bye, guys.